I'm John Bartoletta, Chairman of the Highstreet Group. Today is Sunday, October 12, 2008. I'd like to personally acknowledge Ron George, who is a partner in the firm and who was instrumental in developing the commentary and opinion you're about to hear. The credit freeze, the problems, and the fixes. To understand some of the problems we're facing with the current credit crisis, one must have some knowledge of how a credit transformation model performed by banks actually works. This is important to understand because it is apparent to us that our lawmakers and our Treasury Secretary's actions, comments, and recent solutions do not suggest an understanding of how credit is created and why it may be destroyed if immediate aggressive action is not taken collectively by all G24 countries. The essence of what banks do in normal times is to borrow short-term and lend long-term. This process enables the transformation of short-term assets into long-term ones, thereby creating credit and liquidity. Fractional reserve banking, or the process of leveraging borrowed assets, usually in the form of direct depositors, allows for monetary expansion when the borrowers are creditworthy and have strong collateral. This in turn is the fuel for economic expansion and job creation. This process of having the banks borrow short to lend long is the fuel to run a healthy economic engine. This is true because borrowers, primarily corporate America and international companies, operate on the ability to remain liquid. That is, having assets that are shorter than their liabilities. There's one glaring problem with this economic model, which is now center stage within the recent market turmoil. This credit transformation model, performed by Western banks, is only viable if there is confidence among the contraparties or banks themselves. This contraparty risk is at the heart of what is currently seizing up the credit markets. The confidence among bankers and lenders has been vaporized within a series of missteps by our regulators and legislators. The long end of the borrowing cycle has disappeared, whereas banks only have the appetite to borrow short and lend short, thus absorbing liquidity as opposed to creating it. The stock market's death spiral, the week of October 5th through the 10th, was the worst week in U.S. history and is the result of a massive destruction of credit, liquidity, and contraparty confidence. The risks of this continuing have a simple, well-defined ending: an economic disaster, a depression. One that could make the Great Depression appear as a soft landing by comparison because of the massively leveraged global contagion. Allow me to paint the grim facts if the credit death spiral continues unabated towards a reckless panic. Banks will cease lending to banks. Contraparty risk will demand higher risk premia. Banks will stop lending to creditworthy companies. Expansion and economic activity will abruptly hit a wall. Credit seizures will deleverage banks. Letters of credit will vaporize, and commercial shipping will grind to a halt. Deleveraging of banks will cause leveraged hedge funds to liquidate into illiquid markets, which begets other hedge funds and banks to do the same. Banks will take a balance sheet hit due to mark-to-market accounting rules. Asset prices will be marked to panic prices without regards to internal rate of returns, future discounted earnings, or any other fundamental value metric. The deleveraging of banks will reduce credit, thus reducing or restricting commerce. Less commerce will equal less jobs. Global letters of credit will be shut down, which will stop the shipping of industrial, commercial, and food-related commodities. Commodity shortages will begin to cascade. Consumers will experience price spirals, while the producers suffer worldwide price collapse due to demand incineration and credit backwardation. The loss of jobs and slowing commerce will lead to a radical reduction in the money aggregates, and more importantly, a dramatic deceleration of money velocity. The falling money aggregates and credit contraction will cause worldwide assets to spiral lower. Lower asset prices will equal deflation. Consumer price spirals due to commodity shortages and the deflationary damage to asset prices will end with an inflationary depression. Geopolitical meltdown runs the gamut, with increased risk for military solutions as tempers will flare. The good news is we can fix this mess. Allow us to put forth our solution. First, we desperately need to stop the hemorrhaging, and time is of the essence. So this commentary will be limited to what we believe is a tourniquet to buy us some much needed time. We cannot discount the damage done. The progression of the market participants fearing the worst is becoming evident by the decreased synapse between radical policy actions, bailouts, takeovers, liquidity injections, and rate cuts, and the ensuing global equity sell-off. Urgent, immediate, and unprecedented action needs to be taken, and the participants need to be the world's central bankers, acting in perceived harmony. Anything less will become unresolvable. Here's our preliminary recommendations that need to be taken now. Another global rate cut, with Europe taking a more aggressive lead to reduce the spread between their rates and the U.S. federal fund rate. A 6-month or 1-year blanket guarantee of all deposits by the collective G24 on a proportional basis. Banking triage to separate the solvent banks from the insolvent. The solvent ones to receive public injections of capital for preferred shares, and a cap on executive compensation. A moratorium on all real estate foreclosures for solvent corporations and households. A scheduled reduction in debt burdens of insolvent households and corporations. Unlimited treasury auction facilities and other liquidity injections for a fixed period with options to renew. A massive government stimulus package that includes infrastructure spending, unemployment benefits, tax rebates for medium and lower income households, and grants to municipalities strapped with revenue reductions that have destroyed their budgets. A multifaceted energy independence program along the lines of the Pickens Plan. The reduction of capital gains tax to 0 for an indefinite time period. The immediate reduction of government programs with unfunded liabilities and entitlements, along with a serious look into a radical overhaul and simplification of the 16th Amendment. The 16th Amendment, which has enabled the existence of the IRS, does not allow for taxation on the earnings of an individual. And equally compelling, the taxes it does allow for are for commerce on an equally apportioned basis. Simply put, a flat tax apportioned equally to all, without loopholes and without gradation. The last two are perhaps the most powerful long-term recommendations to reestablish the United States as a world economic superpower. They are not immediately necessary, but need to be considered in the short run. It must be known that, in our opinion, the enactment of these two long-term objectives will create a sucking sound heard globally of currency coming out of international tax havens and flooding back into the United States. The result will be an immediate positive revaluation of all dollar assets, a collapse of international tax havens, and the creation of more jobs in any time since the 1920s. At this point, it is imperative that our leaders recognize that this economic crisis, if not dealt with immediately, decisively, and from a global collective, will bring chaos and collapse to the world financial system. We at HighStreet, and many in our hedge fund community, are outraged at the appalling destabilization commentary coming from the worthless credit watch agencies of Moodys, Fitch, and Standard & Poor's. Their recent announcement of the possible downgrades to Morgan Stanley and Goldman Sachs is borderline criminal. They should be censored pending investigation of their apparent conflicts of interest, notwithstanding their complete failure to act with diligence and competence. Where were you 2 years ago when the writing was on the wall? With that said, we must at all costs contain panic. We have been critical, however, we have every reason to be hopeful about a resolution to this economic crisis. It may take some time, unprecedented Herculean effort, but that effort will result in a much stronger republic and a more courageous global community. I'm John Bartoletta. On behalf of Ron George and the entire High Street team, thank you for watching.